Hi, I'm Dolph Janetz of Clear Income Strategies Group. I'd like to thank you for joining me for a few minutes here to learn the difference of non-qualified versus qualified annuities. The common question I've been getting a lot lately on if I'm going to fund an annuity, I'm going to get an annuity, I'm going to purchase an annuity. Should I put my qualified money in there or my non-qualified money in there? So we're over the next few minutes, we're going to explain the pros, cons, and the reasons one way or the other for it. So what is a non-qualified annuity? First of all, non-qualified money is money that is after tax money. It's money that you've already paid tax on, kind of like the money in your house, the money in your wallet, the money in your bank, CDs and stuff that you've already paid taxes on. That was a non-qualified annuity. One of the benefits of a non-qualified annuity is it's tax deferred. Being tax deferred meaning you don't have to pay taxes on it until you start taking money out of the non-qualified annuity. So people that are 30 years, 40 years, 50 years old that are looking to put some money somewhere to have it grow, protect it, guaranteed, and get something from it later on without having to pay taxes on it is a big benefit of a non-qualified annuity because you put it in there and you can, let's say 50, 55 years old, let it sit there for 5 to 10 years. Now you got this chunk of change at the end of the tunnel that compounded interest three different ways on interest on the taxes on it, the money itself. So big benefit of a non-qualified annuity that way. Also, when they're taking the distributions out of there, I'll tell you in a few minutes, one of the big distribution benefits of taking a non-qualified annuity and turning it into a lifetime income stream. What is a qualified annuity? It's the opposite. Anything that is pre-tax, money that you have not paid taxes on, with the exception of a Roth IRA. A Roth IRA is a little different situation. That is an agreement that once you have a Roth IRA, you never pay taxes on the Roth that you put in or the money that you take out. But for this purposes here, qualified as an IRA, SEP IRA, simple IRA, traditional 401k, 403b, you get the point. All those that you've never paid taxes on, that is a qualified annuity. And we'll talk about the benefits of taking the money out within a qualified annuity anyway. Qualified money is already tax deferred, so that's not a benefit because you're already getting that benefit for a year. But the benefits of a qualified IRA within an annuity is taking your distributions out later on for your RMD purposes. But first, how much tax will you pay on income from a non-qualified annuity? Both annuities are in the exact same way is when you do take funds out from an annuity, whether it's just a free withdrawal, whether it's an income stream, or it's just the interest out there for yourself, it's taxed as ordinary income. That's very important. It's not capital gains. One of the myths out there that some people are going to tell you, it's ordinary income. So depending on your income level, you can dictate, depending on what level or where you're at, whether you're 50, 60, 70, $80,000 a year as your income, you can control your tax structure by how much money you take out of a non-qualified annuity. Another benefit of a non-qualified annuity, let's just say you're taking a lifetime income stream for you, and let's say if you're married, your significant other, and you're taking that money out and you're in year 10, 15 in this, and you're still 15 years in and you're taking that money out, eventually you might start hitting your principal because all the interest might stop. Like right now, the last couple of years in the economy, including right now, is pretty wacky here in 2023. So the gains that people are making aren't as much. So let's just say you start taking money out of your principal. Well, guess what? You've just saved yourself on taxes on that because they're going to pay you that money for as long as you're alive. So let's say you started with 300,000, you're taking out $25,000 a year. Now you're in year 20 and you're still taking that money out for whatever reason. Everything goes to you know what and you know where, and your account's at zero. They're still going to pay you that $25,000 a year as long as you and your significant other are alive. So that's a huge benefit of it. An income annuity and the non-qualified aspects, it prevents you from paying taxes later in life. But taking it out of a qualified account, well, unfortunately, it's a deal you made with the government when you open that qualified account for the tax deduction. Is everything you take out, again, it's ordinary income, but it will last for the rest of your life. Even the only time it becomes tax-free is if you do close out the account and the account runs to zero and you're still taking money out. Well, they can't tax zero as a zero, so they can't tax you on zero. So it's another zero as your hero scenario. But one of the popular things about qualified accounts is most people out there have multiple IRAs, 401ks, 403bs, and so forth out there. And when it comes from RMD standpoint, and you're taking an income stream from a qualified annuity, and let's just say you're taking out $10,000 a year from that annuity, that's going to subsidize almost maybe all of your RMDs for all your annuities on your qualified accounts or all your qualified areas out there, so you don't have to pay taxes on them. I'm not a CPA, but these are some of the tax software issues that we can help you run and give you an idea of what your taxes are. If you want more specifics, obviously you have to talk to a CPA, which we have in-house for you. But the generalization of ordinary income when you're taking your money out, not paying taxes on it, is a big deal, because why pay more than you have to pay? So which one will net you more spendable income? There's only one person that knows, and I'm not him, and he's upstairs. It's because it doesn't know how long are you going to live. Now, if you're living a long, prosperous life, and you have to, once you start taking income from a non-qualified annuity and you start hitting principal, gives you more spendable money because you're not paying taxes on that one. So it sort of leans a little to the left on the non-qualified aspect, but on the flip side, for qualified money, you're paying ordinary income taxes on there. So, and that money might outlive yourself there, and you're still going to continue to get those payments. There's benefits on both sides. You can't go wrong either way, because the most important part about this, the income on an annuity, whether it's qualified or non-qualified, is you can never outlive that money once you set that up as an income stream. And when is the right time to start taking annuity withdrawals? This is a tough question, but the thing is, I always tell my clients when you need it. It's kind of like Social Security, which is also an annuity, except you was given a little tax break until you hit $30,000, and you got to start paying taxes again on your Social Security. But anyhow, if you need the money and you want to start an income stream, what is the right budget for you? Now, Social Security, some people want to take it early and get as much as possible out of it, even though there's like an 8 to 9 year break even point. Or some of them can hold off until they're 70 and get that higher payment and then have that money longer in life. Starting the annuity time, starting with annuity draw, is, again, what fits your horizon, what fits your budget. Here at Clear Income Strategies Group, we're very about having your needs covered and then getting money for your wants. If you get your needs covered from the payment of the annuities and everything else is your wants, you're in golden shape. For more resources, please visit guardyoursavings.com. Any questions, please email me at info@cisforlife.com or give us a call at any time. Again, if there's any questions you'd like us to answer for you and go into full detail with us, you can schedule a meeting with me, or I can be more happy to do a video for you. Take care, God bless, and stay safe. And remember, the best way to make money, not to lose money.